In the last 24 hours, silver delivered one of the most aggressive price shocks seen in decades. While most people slept, silver exploded to an intraday high near $84 before collapsing violently. The drop was not slow, not emotional, and definitely not organic by any healthy market standard. Silver fell from 84.3 to roughly 73.7 in hours. That 11% collapse did not reflect fear, weakness, or traders changing their long-term beliefs. In my opinion, moves this sharp only happen when the rules of the game suddenly change. Balanced markets do not erase billions in value within hours without forced participation. This was not profit-taking, technical exhaustion, or investors suddenly losing faith in silver. What happened was mechanical, rule-driven, and executed at a very precise moment. Silver prices were threatening the paper market structure built on top of limited physical supply. Futures markets are not neutral arenas. They are controlled systems governed by changing policies. When those policies shift suddenly, prices follow rules instead of fundamentals. The trigger was a margin increase quietly issued through CME Advisory 25393. Margin requirements jumped overnight to $25,000 per silver contract. That represented more than a 13% increase applied immediately. Leveraged traders were forced to either add capital or liquidate positions instantly. When thousands face margin calls simultaneously, selling becomes unavoidable and emotionless. Most people miss this part because they confuse forced selling with bearish sentiment. This liquidation did not represent changing opinions about silver's future value. It represented participants being ejected from positions they could no longer afford. The timing mattered because silver had just printed an all-time intraday high. Open interest was elevated and leverage was heavily concentrated among smaller participants. Margin hikes transformed winning trades into liabilities within hours. That is why bids disappeared instead of absorbing the selling pressure. The market was not choosing lower prices, it was enforcing compliance. At the same time, quiet liquidity support was routed through financial system back channels. This prevented larger institutions from failing as futures positions unwound rapidly. From the outside, it looks like volatility. Internally, it looks like damage control. Mainstream explanations avoid this layer because it exposes structural fragility. Words like correction or cooling momentum ignore how the move actually unfolded. Selling driven by rule changes does not indicate trend reversal. It indicates stress. Meanwhile, a major supply shock is approaching that markets have not priced honestly. China's new silver export licensing system activates within days. This policy restricts supply flow without reducing global demand. Fewer exporters will legally ship silver into international markets. When availability tightens in a paper-heavy system, suppression becomes increasingly difficult. That is why this drop looks more like preparation than collapse. Weak hands were flushed, leverage removed, and price reset temporarily. Physical indicators never confirmed a bearish breakdown. Premiums did not collapse. Inventories did not flood back into vaults. In Shanghai, silver continued trading dramatically higher than Western benchmarks. That divergence signals physical tightness, not fading interest. Arbitrage failed because metal could not be sourced quickly at scale. This is the definition of a constrained physical market. Paper selling absorbed the shock, while real demand stayed patient. Fear caused capitulation, transferring exposure from leveraged hands to stronger holders. Once forced sellers disappear, price behavior changes completely. Silver does not drift sideways in a supply-constrained environment. It reprices suddenly when selling pressure exhausts itself. The system relies on margin and narrative to maintain short-term control. Price does not tell the truth during forced liquidation events. It reflects pressure, not equilibrium. This move exposed the fragility of paper silver under rising physical demand. The closer export restrictions get, the more frequent engineered volatility becomes. Not because silver is weak, but because it is structurally strong. The futures market reset leverage ahead of a supply event it cannot stop. This was not the end of a rally. It was a controlled reset before the next phase begins. Futures markets exert control when price threatens structural stability. That control works temporarily, but grows more aggressive over time. Meanwhile, industrial demand operates on long-term timelines. Solar, electronics, data infrastructure, and defense cannot pause consumption. These buyers secure supply regardless of short-term price swings. Physical demand often bypasses futures markets entirely. This creates a growing disconnect between visible prices and real availability. Falling paper prices can coexist with tightening physical supply. That confuses participants who mistake liquidation for waning demand. Retail fear increases precisely when scarcity strengthens underneath. Institutions understand this psychological liquidity trap very well. After margin flushes, liquidity thins dramatically. Even modest demand can move prices violently higher. The memory of the drop delays re-entry for many participants. Stronger hands accumulate quietly during that hesitation. Supply deficits compound when mining and refining cannot respond quickly. Silver has entered multiple consecutive years of structural shortfall. Backwardation signals immediate demand outweighing future delivery confidence. That condition undermines any argument for weakening fundamentals. Futures markets assume availability. Export controls break that assumption. Once supply becomes permission-based, paper loses predictive power. Liquidity can cushion shocks, but cannot manufacture metal. Price eventually aligns with access, not sentiment. When that alignment occurs, adjustments are abrupt. Cheap silver disappears not through hype, but through constraint. Paper claims vastly exceed deliverable ounces. That imbalance becomes dangerous when delivery demand rises. Each intervention increases volatility while reducing credibility. Watching rules, margins, and inventories matters more than intraday charts. In my opinion, attention beats speed in these markets. What we witnessed was strain, not failure. Subscribe if you want clear breakdowns before reality forces repricing again.